Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, March the 3rd, 2026. Okay, so we're waking up to a fairly strong risk-off kind of sentiment. So let's just go back to our sort of a decision tree organogram and see where we're at. So obviously the US struck Iran, also with Israel. The Islamic Republic at this point has shown no signs of capitulation or collapsing. So we don't worry about the top one. And then we go on and say, well, symbolic or no retaliation? Absolutely not the case. In fact, definitely significant retaliation from Iran. I mean, we've had attacks on a lot of the Gulf states. We've had attacks just overnight on obviously military bases throughout the Middle East, but in especially in the Gulf, but also the domestic airports of Doha in Qatar, of sort of Dubai, Bahrain, UAE, all around there. We also had attacks on the US Embassy in Riyadh in Saudi Arabia. And also the United Kingdom, the UK sort of RAF, Royal Air Force Base on Cyprus. There was no retaliation, particularly from the British, but basically, the RAF base on Royal Air Force Base of the UK on Cyprus was also attacked. So the point is that there's definitely significant retaliation. And it looks as that this point is that, it's not as though the regime is going to sort of crumble in a sort of a pro-Western, pro-Israel, pro-American sort of regime will sort of take over. It looks as though yes, the spiritual head of the Shiites was killed. And just by the way, let's not underestimate the symbolic importance of that. Keep in mind that Khomeini was, people say the supreme leader of Iran, which of course is true, but he was also one of the, if not the most important spiritual leader of the Shiite Muslim community globally. So it's akin to assassinating maybe sort of the Archbishop of Canterbury or the Pope or the Dalai Lama or something like that. So for sure, this is, maybe, a lot of Iranians would welcome this, but I'm simply trying to make the point apolitically here. Apolitically, I'm simply trying to make the point that a major spiritual leader for many people in sort of the Middle East was assassinated. So I don't know if it's going to be 100% sort of celebrations. There could be some, let's just call it complex feelings. I'm just going to leave it at that. No, but the point is that getting back to markets, that significant retaliation absolutely is happening. Struck US bases or Israel, yes. Gulf shipping, some instances of that, and strikes Gulf or Iraq, not yet on Iraq. So the question here is that the reason the market, I think, rallied yesterday was thinking, oh, this is going to be a relatively quick airstrike. Oil is still flowing, no problems. But I would say that in my view, and we are a little bit in the fog of war here, but in my view and what I've been reading to the best of my sort of ability and knowledge is that over the last 24 hours, the chances of a quick capitulation by the Iranian Islamic Republic have diminished. Will they capitulate? Will there be regime change? It's possible. But at the moment, it does seem as though, Israel and the US are saying, hey, guys, when I say guys, I mean sort of the citizens of Iran, it would be quite cool if you rose up and revolted against your current regime. But that's a long way of sort of, troops on the ground or, sort of active sort of intervention. So I think there's a huge question mark there. Now, what could cause this obviously to change would be even more sort of attacks. So what would that be? That would be so far in terms of the energy market, we've had attacks on Qatari sort of LNG facilities, and Qatar, which is about 20%, I think, of the world's LNG sort of production. That's basically shut down, which hasn't happened for 30 years. So Qatari LNG is not leaving at this point. There's also some confusing sort of comments about the Strait of Hormuz. It seems that what it does seem is it's not that it's necessarily physically blocked by the Iranians, but in a de facto sense, it's just way too dangerous. And also insurance has been withdrawn for shipping companies for shipments. And so basically, in a de facto way, there's not really sort of any oil or LNG coming out of there. So the point is that that's okay for a few days, but we're talking 20-25% of global energy supplies. So if this goes on every day, this goes on, this starts to ramp up the pressure on sort of availability of energy globally, and we'll get to those specific markets in a second. So the other thing now, which is going to sort of ramp it up even worse, would be any potential attacks on crude production facilities in Iraq or Saudi Arabia. That really would be the next massive sort of spike upwards in energy prices, specifically crude oil prices. But we haven't seen that yet. But definitely at this point, the market is pricing in a slightly more protracted war. Even Trump himself, Rubio, Secretary of State, yesterday was saying, hey, this is probably going to go on for several weeks, whatever that means, or in Trump's words, whatever it takes. Point is, that were very different. This is very different from sort of previous attacks we've had in the last sort of year or 2 years, where there was like a day or two of sort of air attacks, and then Iran came back, just as you see here, with symbolic or no retaliation. We're not in that regime now. Iran is attacking its neighbors, not only the US and Israel, and also very importantly, Gulf states such as Bahrain and Qatar are literally shooting down Iranian fighter jets and bombers, and they're attacking themselves. So one of the things here is that we technically we are in a sort of a regional war at this point. You have Iran versus US and Israel, but also the Gulf states, and we may even see sort of Saudi Arabia getting involved, a whole coalition against Iran. And if the Iranian leadership feels that it's under pressure and in danger of crumbling and being replaced, maybe they're going to ramp up their responses even more and become even more desperate. Anyway, not to sound alarmist or anything like that, but simply to say that that is why the market is very, very risk off overnight. Now, getting back onto more technical matters, let's also just have a quick look here. Just want to look at the ISM manufacturing. And you say, Angus, why are you looking at that? Just want to look at, just keep an eye on sort of this inflation, because obviously higher nat gas prices, LNG prices, energy prices, that is inflationary. Why is this a problem? It's a problem because in inflation, if we have extra inflation, that means that central banks globally may be less inclined to cut and possibly more inclined to hike. And obviously, in the case of the US, that potentially could be the case. And we'll look at that in a second. Now, the problem here is that if you have inflation going up and also central banks cutting less or maybe even hiking, that is a drag, a slowdown on global growth. So this is not good for the global economy. If energy prices goes up, inflation goes up, central banks start hiking or cutting less. So that's that. And that's why the markets overall globally are sort of starting, I think, to sort of feel under a bit more pressure. And we got a second sort of kick in the teeth, so to speak, because yesterday we had the ISM manufacturing PMI survey, which came in. It was a little bit lost just in the all the geopolitical headlines, but it's important to keep in mind what's going on here. And we can see that the overall numbers here, that was higher than expectations, so it came in at 52.5 versus 51.8 expected. So the overall number was high, but also what's kind of interesting is that new orders were pushing up. So this is indicating a strongish US economy. Production was okay as well. Employment was still in contraction territory, but actually going up a little bit. So overall, you could say, okay, this is sort of saying that the US economy is relatively solid in terms of the manufacturing sector. But really, what got the market's attention is the prices paid. And you can see the prices paid here was up to almost 70. Okay, so firms were basically sort of talking about higher metal costs, tariffs, stubborn price increases. So there's a lot of commentary as well. Of course, remember that the ISM services come with a lot of anecdotal evidence, and essentially a very, very high input price, which is essentially inflationary. So you have that sort of domestic tariff-based inflation, or maybe real economy-based inflation picking up. Then you have the whole spike in energy prices. This is a toxic cocktail for inflation expectations, and the market is not loving this. So if we then just look and see what's happening, let's say in terms of Fed expectations, this is where we are. I'm just going to take December of 2026, so not necessarily the next meeting for the Fed, but you can see here that at this point, at the current rate is 350 to 375 range, which is here. So there's still 16% of positions saying that the Fed actually won't cut at all by the end of the year. And you can see here that even what's now, statistically the most probable from a positioning point of view from the Fed funds futures is just for one cut, not two or three or four, but one cut. Now, of course, the probability distribution is also for two cuts here. But the point is that this is changing a little bit. And if you look, let's compare that. So if you look at all of the different scenarios, so for no cut, so the possibility of no cut actually went up from a day ago to today. So this dark blue number is where we are compared to, 1 day, 1 week ago. So compared to 1 week ago and yesterday, the possibility of no cuts actually rose substantially. And you can see that more or less all across the board, the possibility just for one cut went up substantially. and you can see the possibilities of 2 or 3 cuts was reduced. So basically, the probability distribution for the Fed has gone to the right, which is further to the right means just 1 cut or maybe even no cuts by the end of the year, which is very logical. So let's now look at a few different charts and see what's happened. And essentially, overall, what's happening here? Where am I? Sorry, let's go on to this one. Is the following. First of all, volatility very, very high. Look at the VIX, ripping high. We're now into the mid to late 20s. Remember that, and just a basic approximation of mathematics, about 16% is essentially sort of a 1% move. So if you get up to almost 32% on the VIX, it's I would say forecasting, but encompassing as a possibility up to 2% moves. Now we're not there. So essentially what this is saying is that a 1.5% move either way, not necessarily down. Remember that volatility, a lot of people just go, oh, the VIX is up, therefore the markets have to move down. The point is that when volatility is elevated, there's a probability distribution, which could also be on the upside. And we saw yesterday, we had fairly positive price action from the equities. Point is that volatility is elevated on both sides here. So excuse me. Very elevated volatility. We're also seeing elevated volatility in the bond market. Look at the move here, very, very elevated. And if we look at oil, for example, no surprises that oil vol is through the roof. So volatility very high. So what does that mean? That means that vol targeting funds, CTAs, so trend following, every single institutional book will be automatically, mechanically reduced in volume and risk just because of the extra volatility. As volatility goes up, potential losses, the value at risk goes up, and therefore institutional trading desk, the risk managers automatically and mechanically, I'll repeat it, reduce their size positioning. It's not a market choice going, oh, we think the market's going to go down. It's simply saying, hey, every part of volatility going up, every percentage of volatility going up, we reduce X percentage in our positions. So therefore, mechanical deleveraging happens. So we can see broad equity globally down. So if we go through all the charts, ES absolutely, very nasty overnight. And you see yesterday the ES was rejected at the 50-day. We've broken through the 100-day EMA, and we're now at sort of pretty key support. But as you can see here, between the 100 and the 200-day. So the point here is, where could this go? We bounced off that initial, that's going to be the line in the sand for the moment. You've got to say if it breaks down through there, we've got the next level down would be 66.75. And then, of course, you go all the way down here. We're not there yet. So far that's held. Let's see. We have NASDAQ also holding at a lower level at the 200-day and this support. So pretty good support level here on the NASDAQ around about the 24,350 here. But as you can see, moving averages are breaking down here. And this will definitely have to hold over the 200-day. That looks like the line in the sand here is the 200-day EMA at about 24,500. Russell also breaking down, not quite as weak as the other two indices, but looks like it wants to test this recent low at 2,560, or maybe the 100-day EMA is also another key level here. Point is that those indices are breaking down, and we can expect some weakness this morning. Also, what's interesting is that Europe for the first time, so if you look here at the SPY versus Europe and the Far East, now, as you can see, that's been sort of a negative trend. So North America underperforming the rest of the developed world. But you can see here that is starting to reverse, and the US markets actually outperforming in a negative way, so less stinky, shall we say, than the other markets. But if you look at Europe, the Euro Stoxx 600, huge fall, 3%. You can see that this is testing the 100-day. We can also look over at Germany, a massive fall there, almost 4%. So Germany down now below the 200-day. So obviously Europe is closer to the fallout and being really affected by gas prices. Just in terms of global equity, very, very interesting, because we're seeing Japan here having a big fall. The Kospi finally, the Korean margin calls probably coming in, sort of leverage being taken out, so a big rip lower in the Kospi. We're also seeing emerging markets having a big fall, and you can see in the pre-market they're going to be down more. Which markets are going to? Who are the winners and losers here? So first of all, let's focus on energy. So if we look at Brazil, which is an energy exporter, look at that. Brazil down a little bit, but basically the Bovespa doing pretty well. Also, what's very interesting, if you look at the currencies, you can see that the Australian dollar. So let's just look at some of these energy prices here, and we can see that oil ripping a lot higher. And what's crazy is that it couldn't test into the it tested a bit into the gap, but overnight, just on the fact that the Strait of Hormuz may be attacked, ships in that strait, and may be closed, and in a de facto way, nothing's leaving. So it's almost like de facto semi-closed. Oil ripping high. Now, where could this go? You can see the levels here on the WTI here. So you can see that obviously 80 bucks, that sort of level up there is probably the next key level. So that's where we're at the moment. That looks like the new trading range could be between 80 and let's call it about 75 bucks, something like that. So oil, very concerned. And again, we're going to have to see what happens on the Strait of Hormuz. There was talk yesterday from Rubio that there would be an announcement today, so Tuesday, about measures to alleviate the price of oil in the US. So what does that mean? The Strategic Petroleum Reserve, maybe Trump will authorize the SPR, the Strategic Petroleum Reserve being opened. But the point is that, the world consumes over 100 million barrels of oil per day. America produces, 12, 13 million barrels per day. So, the question is, going through the Straits of Hormuz, you've got something like approximately 20 million barrels of oil per day, and also the nat gas, the liquid natural gas. So the thing is that if Trump were to open the Strategic Petroleum Reserve, which from memory, I have to check that, I think had about 600 million barrels of oil. The point is there's plenty of oil there, but, we're in a war situation, and globally, how much difference can that make? So let's keep an eye out for that. That could cool down the oil price ascent if the SPR is open significantly today. Let's see what Trump has to say. But the time spreads are going up. You see oil going up. And really what's very, very damaging is also the nat gas. This is the European benchmark, which in some sense is like the global benchmark, the TTF over in Europe. I don't really need to say much about this chart. Let's just look at that. Is simply to say that obviously it's ripping much higher. Now, are we at Russian levels? The Russian invasion of Ukraine, just for perspective. There you go. It got all the way up to 150, 160 euros up at that point. So that's the Russian invasion. So, this is a massive spike. We're not yet at Russian levels. You can see here some sort of key levels here. Will it calm down at about 63, 50, 60? So the point is, once it gets up here, we have some massive problems. We already had problems because essentially the losers in the world are energy importers. Who are energy importers? Korea, we just looked at the KOSPI. Japan, Europe as a whole, a lot of Southeast Asia, India, China in the middle is a large importer. All of these currencies and these countries' economies are being hit hard. Who are the winners? Net energy exporters. So the US dollar, 13 million barrels per day. Australia, which is one of the world's largest exporters of nat gas. Now, if all the Qatari nat gas has been cut or not available for shipment, that is great news for the Australian exporters. So these countries are doing very well, and that's being reflected here in some of the in the currencies. We had a massive breakout here of the US dollars. So if we look at the DHX, the Dixie, you see the last couple of days. Now remember, this very, very key level we were signaling for a long time, that the fib retracement level, which was at about 98. Basically blew through that. The 100-day, we're now above the 200-day, testing this recent high at 99.5. And this is because, the US, it's a safe haven. And secondly, in terms of energy, it's a net exporter at this point, and one of the world's, actually the world's largest producer of oil is the US. So the US dollar are benefiting from the energy situation, but also the safe haven state. So the fact that the US dollar is ripping, obviously everyone else is under pressure. And you see, especially Europe, look at the euro here, down to the 200-day moving average, blown through all of the technical levels here. And again, testing this 200-day EMA. Let's see if we get a little bit of a bounce. Again, Europe is an energy importer. And as I say, higher inflation. We had higher inflation numbers this morning from Europe as well, if you want to have a look at those. So even the inflation numbers internally in Europe are higher without even talking about energy. So higher inflation risks that the ECB may even start considering a hike, a drag on growth. None of this stuff is good for the euro. And you can see here the euro being absolutely destroyed. If we look at Japan, similar kind of situation here. Are we getting into intervention territory? You can see that the Japanese yen weakening here as the US dollar goes up, again blowing through, sort of downtrends, fib levels, moving averages, and it looks as though it wants to test up to the 158 level again. Japan imports, I don't know, maybe 100% of its energy needs. So Japan being absolutely whacked on these higher energy prices. We can also see in China, interesting to see what's happening here, the US dollar reversing a very significant amount of weakness against the renminbi, and you can see that there. That's going up. Now, who are the winners? Now, if we look at, let's say, USD sort of CAD, you can see not really much going on. This is actually kind of good for Canada's balance of payments, because we all know that Canada produces a lot of sort of heavy oil and some nat gas. So not much happening there. But let's look at the Australian dollar, which down a little bit today, maybe just on the massive risk off, but basically had a pretty good day yesterday. And if we compare that, let's say, to the New Zealand dollar, which has just been straight down. So the Aussie dollar starting to be weighed down by the risk off tone, the strong risk off tone overnight. But on a comparative basis, yesterday had a very strong day and now is down, let's say, less than the others. So let's say, look at the Aussie dollar versus, let's say, something like the yen, or let's say the euro. So the Aussie dollar is still outperforming. So on the cross pairs, you're going to see some strong performance here. So if we look at some cross pairs, let's say the Australian dollar versus the Japanese yen, you can see here just how strong that performance has been. Maybe the Aussie dollar versus the New Zealand, you can see that's also been very strong. So the point is that countries like Brazil on a relative basis doing okay, Australia on a relative basis doing well, and just a couple of quick notes on that. I've got a couple of cute charts for you here, because I know anyone listening to this that you do love a nice chart, and you can see here the net oil and gas trade balance as a percent of GDP. You can see here who's it good for is Australia, for example. You see that overall, its trade balance in terms of energy is positive. But then you can see, for example, China, it's negative, Japan, negative, India, Singapore, and all of Asia. You see a lot of these Asian countries all under a lot of pressure. But let's just look at, let's say, sort of Japan and China here. You can see this is not good. Now, if you also look at currency, this is kind of interesting. This is looking at the elasticity. So the way it changes, all of the currencies in blue, and also sort of gold and the S&P in terms of how oil prices change. And this is based on the Ukraine invasion. So I don't know if it's perfectly analogous, but the point I'm trying to make here is that if you have higher oil prices, you can see that the Brazilian real is very, very reactive to that. You can see that the South African rand is very, very reactive. You can also see that some of the, the Colombian sort of peso is generally reactive to that, and in Mexico and Australian dollar and Canada. But then you say, well, okay, who doesn't like it? And you can see that countries like Turkey, which is a huge importer, hates it. You can see that the UK doesn't like it, the euro doesn't like it, et cetera, et cetera. Okay, so kind of just interesting there to see what's going on. And just while I've got the charts up here, guys, I just wanted to show you what's happening with the Strait of Hormuz. So the point is here, the 7-day moving average is the purple line, and that's the daily, chop, 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 chop. But look at the 7-day moving average, the amount of oil going through, which is typically, almost about 20 million barrels, 18 to 20 million barrels. It's going off, it's going down. So whether the Iranian Revolutionary Guard has sort of actively or actually sort of blocked it and attacking shipping, the point is that it's so dangerous that ships are simply not sailing through there. They're not leaving. Airspace is also closed in the Gulf, and the shipping routes are closed. It's also prohibitively expensive for the shippers, because the cost of insurance has gone parabolic. And so shipping owners are saying, hey, let's just chill for a few days. So it's really critical, because what's happening is that the energy is not getting out. It's causing inflation expectations to spike. So we have to be watching this number, because every single day the oil the market the global economy rather is losing maybe 15-18% of its energy needs. Now, are there stockpiles? Absolutely. But are the stockpiles diminishing? Yes, they are. So the longer this drags on, if this drags on for 3 days, 5 days, a week, more and more escalation, we can see the energy prices going up, inflation expectations. And just talking about inflation expectations, just want to have a quick look at a couple of markets here, get on with things. Bonds being absolutely destroyed. And what's very, very interesting here is that if we look at, let's say well, let's just look at the front end. We initially had a rally, but you can see on Sunday night, the inflationary implications soon became obvious to the market. So look at the front end here. You can see ZT down to the 2-year. Look at the 10-year, like absolutely collapsing. The ZB, very, very sensitive to inflation. So the point is that inflation expectations, because of energy spiking, and inflation just going up, we saw like the ISM manufacturing is absolutely destroying the bonds. So you say, well, hey, aren't US Treasuries a safe haven? That's absolutely true. But the point is that they're being sold, A, just to reduce exposure, but also they're being hit by inflation expectations. So you say, what are the safe havens now? Well, maybe it's gold, but even gold, which had been rising, you can see that gold has also sold off aggressively overnight. It's stopping here at the 20-day EMA. This is the spot gold price. But you see here it initially rallied, but essentially has come off as well. And that's just because of, yields are ripping higher, the US dollar is ripping higher, inflation expectations are ripping higher. So eventually that might be a bit of a safe haven, but just at the moment, it's being sold on fears of runaway inflation and a very, very strong US dollar. And secondly, as I said, probably margin calls, because as every other asset, we're seeing all the equities are going down globally. Um, and whatnot. So basically, gold is a safe haven. It's a form of liquidity. So we saw this during COVID. We also saw this a little bit during the Russian invasion of Ukraine, but especially during COVID. In the first day or two of the COVID crisis, gold was actually sold hard. People say, hey, what can I sell to cover these margin calls, to cover my losses in equities and bonds? They go, oh, maybe gold. So the point is here, gold is not working as a safe haven. Equities is obviously not a safe haven. So what was I going to say? US Treasuries are no longer a safe haven. This is a very big risk-off liquidation. So, it's going a little bit into things like maybe the Swiss franc, things like that. But even the Swiss franc, the Swiss National Bank yesterday said they may have to intervene if the franc gets too strong, because that's going to be causing sort of a deflation at home. But that's an interesting one to be looking out for, as you can see here. So gold down, silver, massive sell-off, a big sell-off as well. It can also, no surprises here that a copper also sort of selling off. Okay, what about BTC? Surely that's a store. Now, it had a bit of a positive bounce yesterday, not really selling off massively. So this is interesting. And, I've been saying that the price action on BTC has been weak well, obviously for a long time. But we have to say here that BTC is actually had an up day yesterday and is not massively selling off. So that's a relatively positive sign, I would say. And you can see here that we're, failure to make new lows here. Are we starting to form, a slow flattening out of some of the moving averages here? And are we starting to form some sort of a basing formation here? I don't know yet. I would personally probably want a little bit more confirmation to say this is a bull market. So there's two options here. You can wait for a little bit of confirmation here, or you could be a little bit of a rock star and say, hey, I'll give it a shot and have a stop loss. But it's definitely getting interesting. And if we just look at the fib levels here, we have to be watching. Let's have a look. Let's look at the reversal. If we just look at this most recent down impulse, you can see here that the BTC market has not actually done anything. It's simply trying to form a base. I would describe it that. I wouldn't say this is a bull market in any shape or form or a breakout. It is simply trading along the 20-day moving average and hasn't made a new low and is trying to, as I say, carve out a base. And, at this point, at a minimum, what the bulls need to do is to get up to this level here, which is the 38%, which is about 72,170. That's the first thing. So that's the first target. Let's see if the bulls take it up there. Any failure to get up there, if it can't get up there and is sold at that point, that is not looking good. So at this point, I'm neutral, but also saying, this is interesting because, compared to, let's say, silver, gold, US Treasuries, and equities, BTC is actually hanging in there. And maybe that's a positive sign that the majority of the selling is over for now. So that's definitely an interesting one to be looking out for. Okay, other stuff to be looking out for today, guys. Obviously, some of these key ETFs. I'll be keeping an eye on jets. For the airlines, we still see all of the Middle East airspace. A lot of it is closed. Dubai, one of the world's major hubs. You can see yesterday we had it gapped down in the pre-market. JETS jets not doing well. Let's keep an eye on the let's say the aerospace and defense. Obviously gapped up yesterday, down a little bit with the general sell-off in equities, but that could remain relatively strong. Although the aerospace component is not great in terms of, but defense should still do relatively well. I will also just want to be keeping an eye on just some of the equity subcomponents, like the semiconductors, see how they hold up. Again, they shouldn't be dependent on oil prices particularly, but they're going to be taking in the downdraft of equities as well. So we can see that, for example, SMH is down pre-market, although it had a relatively good day yesterday. So that could be a buy on dip, something to keep an eye out for. And of course, just the software space, we could see IGV down a little bit with general in equities in the pre-market, but that's starting to sort of again form a little bit of a base and was obviously very, very oversold. Finally, having a quick look at the Mag 7, again down in the pre-market a little bit and hovering around that 200-day EMA here. Let's see if that can sort of hang in there. And again, that could be sort of a buy on dip at some point. But I repeat, for the markets to pick up, we will have to see some sign potentially of a de-escalation from either the Americans or the Israelis, and we haven't seen that. Both the Israelis and the Americans at this point are definitely talking about a multi-week campaign. They're talking potentially about regime change, but maybe they're not talking about regime change. It's clear that there's no particular plan, and things could actually get fairly messy before they stabilize. So it's not, even if the regime in Iran falls, it's not, there could still be more messiness because there could be conflicting sort of parties aiming for power. Who knows? It could be a sort of a vacuum. So the point is, as long as we have sort of disruptions to energy, increased inflation fears, and potential for a global slowdown in growth because of less accommodative central banks, we could continue to see equities under pressure, and obviously oil. What we will be looking at, as I say today, keep an eye on the BTC charts. Some of these equity baskets, but I'm also particularly interested to see if gold starts to sort of stabilize a little bit, because that could be a sense that some of the margin calls and the liquidation is over. So think of gold at the moment as a kind of an indicator of global liquidity question marks, and also the bonds, of course. All right, guys, sorry to speak too much, but quite a lot going on. Have a great trading day. And as I say, keep an eye on the VIX for volatility. And remember, it can go both ways. So don't necessarily equate a bounce with positivity. It could just simply be a bounce due to sort of, expanding volatility on both sides, up and down. Have a great day. I'll be back tomorrow with the macro snapshot from the Macro Shop. Thank you.